I'm Claire Smith, here to give you an update on the Schroder Specialist Private Equity Fund. So I thought I'd start with a review of the year and our investment activity throughout 2024. As you can see, throughout 2024, we invested $2.5 billion across approximately 100 investments. As is our label, true to label, we really focused on the small to mid-cap segment of the private equity universe, where we see excellent relative value opportunities. Interestingly, you can see 80% of our investments to funds are less than $2 billion in size, whereas you may be aware that the majority of investments go into funds above $2 billion. So again, we're really focusing on that part of the market where we see good relative value. We've also just put down the right-hand side of this slide some stats around the median value of the companies we invested into, because again, we think this really proves that we are true to label on the small to mid-cap segment, with our median co-investment enterprise value being $350 million and our median GP-led enterprise value being just over $650 million. Moving on, you can see here the difference in purchase values between small and large cap private equity companies. That gap, which has been pretty consistent over sort of the last 15, 16 years, has even widened a little bit in recent years. And this is again, as we've seen more money going into the large cap private equity part of the universe, which is driving up prices there. You can see the blue line on the left-hand chart, the enterprise value or the purchase prices for small to mid-cap companies has remained really consistent, which is what we love to see. And as that gap has widened, that means we can influence more in terms of return from that multiple expansion. So if we're buying companies along the blue line, growing, professionalizing those companies, and then able to sell upmarket at a higher enterprise, at a higher multiple to the large cap buyers, again, that's going to help really drive the returns of the fund. I thought it was good to look at sort of the year that was in 2024 across both private equity and listed markets, just to show the difference in returns. This is only unfortunately up to the first 3 quarters because there is obviously a lag in the private markets data. But what this shows is, as you all know, listed markets had a stellar start of the year in 2024, delivering those high double-digit returns. Private equity, as we say in a normal cycle, they will lag on those really strong rebounds in markets, but they'll offer a nice buffer on the downturn generally. But again, you can see that small buyouts has been the star of the private equity returns throughout that first 3 quarters of 2024, outperforming both mid and large. And again, this is where private equity is really providing that important portfolio diversification, because obviously, as we know, listed markets haven't had such a good start to the year in 2025, but hopefully we'll see that private equity is providing that resilience in the portfolio and that source of diversification to returns. So moving on, just as a bit of a recap to the Schroder Specialist Private Equity Fund. As a reminder, this is a fund that's investing 100% in private equity with a real focus on small to mid-cap buyouts in US and Europe, and then with a small sleeve of Asia growth. It is 100% private equity just with cash, monthly applications, quarterly redemptions, all available through an Australian unit trust. And as you may be aware, we don't charge any performance fees in this fund, which is quite unique in the world of private equity. You can see the portfolio composition on this slide as of 31st of Jan 2025. So we've got that large allocation to buyouts sitting at 87% of the portfolio. Growth is a little bit below our target, but that's in line with our Asia exposure again, which is a bit below the target. When we first launched the fund, we did indicate a target exposure of 20% to Asia, but with the geopolitical situation, we've kept that closer to that 10%. You'll see that sort of fluctuate in that 10 to 15%, but we are keeping it a little bit more conservative, particularly given the geopolitical situation in China. You can see Europe is still a strong composition of the portfolio, balanced nicely with North America. And as we'll come to later, Europe has been one of our strong drivers of growth for the fund. Importantly, you can see the large investment to direct co-investments, which is obviously alongside GP-led secondaries, 2 of our strongest performing parts of the portfolio. A very small allocation to traditional or LP secondaries at only 3%. And then you can see a small allocation to primaries as well, sitting at 10% of the fund. From a sector perspective, technology and healthcare are always our 2 largest sectors, and then balanced with consumer, industrials and business services. Just moving on, you can see on this slide a snapshot of the portfolio. We now have 320 companies on a full look-through basis, but with really 90 of those companies making up the large percentage of the fund. So we're very happy with the diversification of the portfolio. It's diversified across regions, across sectors, across types of companies, which is really nice. The master fund is now over 5 years old, and the Australian feeder fund actually just celebrated its 5-year anniversary. So the portfolio has been nicely built out in quite an organic way over that 5-year period. We've been lucky that every quarter we've had more applications than redemptions, which has allowed us to naturally average in the investments within the fund. Just moving on to the portfolio diversification by general partner, you can see nice diversification across GPs as well, which is important because these are the individual managers on the ground running the value creation levers of each of the underlying companies within the fund. So Archimed is our largest GP manager. They're a very strong healthcare manager. Norvesta, a really strong Nordic manager. Trinity Hunt, a strong US technology manager. So nice diversification across those individual managers who have that real on-the-ground sector expertise. Moving on as a recap to the fund performance throughout 2024, we were happy to deliver a 15.2% net performance throughout the year, which brings the total portfolio since inception to 16.4%. We do have a breakdown, as you can see on this slide, which shows the investment return in natural currency. So that was 8.2%. So again, much above the small to mid cap index for 2024, although obviously we did lag listed markets given the really strong rebound in listed markets. You can see then a bit of a contribution from the investment in money market funds, obviously netted off by fees and costs within the vehicle. And then within the Aussie dollar feeder fund, we did benefit quite a bit from FX throughout the 2024 period, which brings that total net return to 15.2%. But still a strong fundamental investment performance, obviously balanced by FX in the 2024 year. Just moving on as well, we have the investment results by sector throughout 2024. So this is really interesting in that all our sectors have performed really well. Obviously healthcare, consumer business services and industrials all producing really strong results. And actually our weakest sector, the only one that performed negatively throughout 2024 was technology, which is quite different obviously to listed markets where clearly the Mag 7 have dragged up those investment returns. So again, this is showing the diversification benefits of our fund versus listed markets. We're not going to give you the returns that are correlated to listed markets. We're going to give you returns that are largely independent of those market returns. So again, really showing the diversification benefits of this fund. Again, when you look at the performance contribution by region, Europe was our strongest performer. Again, obviously, as you all know, in listed markets, the US really led the charge in those investment returns in 2024. So again, we're comfortable that this fund is really delivering those diversified returns that you would hope to get from a fund like this. Asia was our weakest sector in 2024, combination of obviously the geopolitical arrangement and that one underperforming company in India, as I mentioned. Although we are still generally bullish on India and looking to get a bit more exposure there because that as a whole sector within our portfolio is performing quite well. So we do want to give investors exposure to that thematic through the fund. Just moving on as a quick summary of the companies within the fund, you can see the top 10 companies all performing very well. Sales growth is strong, EBITDA margin, so the profitability of those companies is all really strong as well. And you can see as well very conservative lending structures with 70% funded by equity at inception and only 30% financed by debt. So again, we're not as worried with debt service burdens with interest rates obviously being a bit higher now than they were in the past. We're confident that the companies are positioned well to still withstand any volatility in markets, which is obviously getting reintroduced now. So moving on to market outlook, I thought I would just recap this slide. We've showed it a few times showing the long-term outperformance of private equity versus listed markets. You can see from the chart on the left, that's that 4% outperformance or basically a 50% premium to listed markets from 1998 to 2023. But when you strip out those periods of heightened volatility, that return dispersion reduces to only a 25% outperformance, still 4% in absolute terms, but 4% off a 16% base in listed markets. So when you look at the next slide and you show the composition of all those heightened periods of volatility, being the dot-com crash, the GFC, Eurozone crisis, COVID-19 and outbreak, and then return of inflation, you can see that's where private equity has really punched above its weight in terms of providing an 8% performance versus listed markets as opposed to that 4% outperformance over that entire period. So as we are seeing more volatility in markets, we're entering a more choppy period. We think that's where private equity is really going to provide that nice diversification to your portfolio and should produce that relative outperformance versus listed markets. Moving on to a bit of a map of the world, just given, as we said, we are entering a bit more volatile environment. There's a lot more going on. When it comes to our small to mid buyout part of the market, obviously there's the focus on tariffs. The companies we invest in are generally much smaller, local to local businesses. So we're not really as worried about trade wars within the portfolio. We are worried if those trade wars often, lead to a broader economic downturn, and that has a contagion effect across the whole market. But from an individual company portfolio position, we're pretty comfortable because these small to mid-cap companies are very much local to local businesses. Again, Asia, we are managing that quite, carefully. We're looking at our exposure in China, and we're being only very opportunistic about investments in China. But then we are still relatively positive on India, as I said, and trying to build that out a bit. Venture capital obviously doesn't play a big part in this particular fund, but we do have quite a strong venture team. So we are obviously really carefully monitoring all the developments in artificial intelligence and particularly how they could impact our portfolio companies. So having that ecosystem of that venture capital team is really useful for the underwriting process. So just finally, to recap, we're feeling pretty confident with the fund and the positioning in the market. We have really focused on a segment where we see good supply-demand dynamics, being the small to mid-cap segment, where there's less capital chasing a larger number of companies. As I said, there's a really large universe in that small to mid-cap segment. It's a very fragmented market, a lot of opportunities to find really good quality companies at attractive entry prices. The fund really focuses on taking those companies and growing them from within, so transformational change from within the company rather than relying on market factors. So again, that should play well into whatever market economy scenario we're entering. And then again, focusing on businesses that can pass through those inflationary or interest rate pressures, largely mission critical technology, healthcare, obviously, strong trends there with people living longer, spending more money on healthcare. And then finally, again, the companies we've invested into have lower debt service burdens. So again, feeling quite comfortable with the long-standing profitability of those companies. Thank you very much.